record. Good morning, Rohan. How are you?
Good morning, Mr. Clayton.
Thank you so much for joining me today. We got a lot to go over, don't we?
We do.
We've had quite an eventful week this week. We had the FOMC meeting, which we covered in our lives this week through OBR, and we had quite the extension downwards on Monday and have recovered the better part of it, which is unbelievable. A very aggressive retracement up. And speaking of aggressive retracements, and maybe something that might be overall on an annual basis, year by year, might be a little overextended, as Rohan and I were discussing, is today what we will be talking about, which is XLF, which is the banking ETF, the Financial Select Spider ETF. The proper name is Select Sector Spider Trust Financial ETF. So that is what we will be talking about today. Rohan, you might do me a huge favor in giving me the top 10 holdings for XLF.
I do not mind. Let's go ahead and get right into this. The first holding with around 12.6% of total net assets, Berkshire Hathaway, Berk B. Next largest holding, 11.2%, and my employer, JP Morgan Chase and Company. Then we have following Bank of America Corp, Wells Fargo, Morgan Stanley, Citigroup, Goldman Sachs, BlackRock, Charles Schwab, and American Express, topping out your top 10.
Yes, there you go. I appreciate that very much. So there is a lot involved there, right? We've had a lot of fluctuation with those securities within this ETF. However, Rohan brought to my attention that in the past, what was this? You said 2007. You want to go over that real quick?
No, I don't mind. So looking at the historical data of XLF, and this is like essentially any, like you look at a Dow Jones or like an S&P 500, since 2007 and the housing market crash at all-time highs, if you look way back at March 18th, or was it May 18th, 2007, you had to have been holding for approximately 14 years, give or take, to finally see some profit on this. So in order for you to see some long actualized gains in XLF, you had to have been holding, as you can see on the graph, from that very peak to right about, I want to say, March of 2021. So price action has just now started to be profitable for those back in 2007. Lots of people from way back when are starting to feel euphoric. We could see that trend line way back when from that all-time high serve as a nice support level to bounce off and reach new highs, because people from back then are looking for this to continue. So let's see how this goes.
Yeah, I think this is, I mean, this chart is just unbelievable. Again, everybody understands that in 2008, the banks had one hell of a time, especially on the security side of things. So looking at this, I mean, XLF has been a phenomenal buying opportunity for the better part of 10 plus years, which is incredible. And now the banks have done the most amount of linear growth, in my opinion, based on the holdings that Rohan gave me, that I've ever seen. And I have not been trading for that long, but I look at historical data. Rohan constantly tells me to look at historical data. It keeps me in check, which is great. So looking at this, it's just, we were going over the low. Well, let's move over to the 180-day chart here and let's look at this. So 180-day chart is a much higher time frame than the majority of day traders, scalpers, swing traders look at. But longer term traders, and I'm a longer term trader, and I will go over a trade that I made this past week when XLF pulled back. I will go over that trade in full and we can talk about that and how I leveraged it. It was a week-long trade, but it was a very long-term minded trade. And the position did way better than I thought it would. So I got out, right? Hit my price target or got very close to it and I got out. But that being said, for the past 180 days, if you divide $28 by $39, which is the high right about, you have a 30% gain in less than 180 days. I cannot find in the past 20 years where XLF has been able to do that, right? So that means the banks are moving, and I'm trying to figure out what's going on in the banks that's really producing this. Rohan, do you have any opinions on that?
Yeah, so the spotlight on investing after the COVID crash has been absolutely exponential. A lot of these people go through prime broker and broker transactions when purchasing securities. Now, this can be from the retail side and this can be from the consumer side. I know, wherever prime broker, broker dealer transactions happen, there are retail clients, there are investing clients, and there are long-term clients as well. So with that COVID crash, everybody and their mothers literally started to get on investing and trying to get their portfolios at the best possible location that they could be. Then the GameStop squeeze happened, right? So with that happening, banks saw a large inflow of trading and a large inflow of orders, and lots of people who were, marginalizing their portfolios, were using other factors to help them gain more money in the market. As a result, there's more cash flow for banks, there's more revenue, increased consumer confidence, increased shareholder confidence, and it leads to a domino effect, which is where you see XLF right now.
That is such a phenomenal explanation. I could not have come anywhere close. That's why I'm asking you the questions, right?
Hey, man.
So, first of all, I appreciate that, Rohan. Second of all, I want to start looking at some of these holdings so that maybe we can see some reflection in the past 180 days. So, and then I will go over the XLF trade so that we can maybe have something technical to apply for a future trade. So, one of the largest holdings I heard you mention was your employer, JP Morgan, JPM. So, last 180 days.
Looks very similar to XLF, by the way.
It does. It does. I mean, we're getting to a point where we can stack some of these graphs. So, and JP Morgan's been doing very, very well. And every single major dip that we've seen in the last 180 days, and we've got a couple of very hard support lines here across the past 180 days, right here and right here. Every single major dip JP's seen, it's eaten up. So from a trader's perspective, if you guys are just patient enough to wait for these major pullbacks, which we can go from, we've got a very large run here. We've got a smaller pullback, large run here, pullback, run, pullback, run, pullback. One of the ways that I look at trades in regards of entry specifically is I try to find an average. I try to find a range in which stocks run and then where they fall to. And
if you also look at the technicals, right, of JP Morgan or any financial institution, honestly, really any graph, it's a game of derivatives, right? As soon as the graph starts to taper is when you see, okay, there's like decreased confidence in this, maybe a little bit too much greed, then you see the drop. If you can see from between the first earnings or the first dividend, sorry, and the second dividend, it started to increase and then taper, and then it dropped significantly. This is from the first dividend increase or the first dividend yield to the second dividend yield. It increased significantly, dropped, and then goes up, tapers, drops. So from a technical standpoint, it's definitely great to look at that way.
Yeah, that's phenomenal. And the other one you mentioned was I believe BlackRock, correct?
BlackRock, and the other largest holding is BRK.
BRK, all right. Ooh, what's the ticker symbol for Berkshire? I haven't looked at it in 5 years.
It's BRK.B, I believe.
BRK.B. Oh, there's a common stock. See if we can pull that up. Oh.
If not, let's just go BLK, BlackRock.
Yep, there we go. So BlackRock has done unbelievably well. I had to convince myself this past week not to start trading BlackRock because it's just there's a lot of these bank stocks that again their valuation, in my opinion, is a little bit overextended, but they're still doing super well. I mean, now that the stimulus checks aren't coming in, people are utilizing more credit. We've got more retail traders in the game, so that means more assets under management for the hedge funds, for the banks. We've got 50% increase in retail traders. That means that's a lot of freaking people who need brokerage accounts, right? And that's what these banks that's what these banks provide. So for BlackRock specifically, wow. We're up. We've got an average that we were trading out right at the 720 level, right around here. If I were to draw a line through this range, And now we trade all the way up to 800s, 900s. I just, it's an unbelievable return for BlackRock shareholders and people who are buying into this company. What do you think what do you think's influencing the stock price with BlackRock specifically?
The amount of assets that it has under management, right? BlackRock has the most amount of assets under management of any financial company across the market. So with that comes a large variety, a large slew of clients they handle. It's not just primarily in the securities trading industry. It's more so asset and wealth management. So with more people going to BlackRock for, a lot of their services for their personal portfolio and wealth management, they see a large influx of revenue. So that being said, BlackRock is trading in these levels significantly because of the fact that it has lots of practical implications with how it's being used and the number of and also, the revenue that it posts on a year-over-year basis with large revenue growth.
It's an unbelievably large number, Rohan. Unfortunately, my poor brain can't wrap my head around numbers like that because they've got what, $9 trillion in assets under management.
Yes, absolutely, a little bit more than 9 trillion.
So that's just it's explaining to everyday folk like us, good old folk.
Good old retail investors.
Good old retail investors. That's a lot of money. So, all right. So, Rohan, if you'd like to add anything else to the XLF and or BlackRock and or JP Morgan or holding conversation, speak now, forever hold your peace. I want to go over some technical trading.
Absolutely. So we can go ahead and say that the price targets for BlackRock are around average $1,000, high price target of around $1,100, low price target around $803. JP Morgan Chase, high price target of around $250, mid price target of around $200, low price target around $150. So then we look at some of these XLF, things as well. High price target for XLF rises around $41, $42 a share on the high end, and low price target for XLF rests at around 36.
There we go. So that is phenomenal. That is phenomenal. So I want to go over how I trade long and take profits in the short term. So guys, there's a lot of you all that trade in a 5-minute candle, right? There's a lot of you all that trade during the day or hold the trade open for an hour or use multiple hours during the day for a major price swing. And then again, there's my favorite group of people who are in and out of a trade in 30 seconds and they're leveraging 10 grand a trade. Those are my favorite. Those individuals are built like no other. But that being said, I do not necessarily fit in all of those categories. As the OBR host for our live calls, I am trying to accommodate everyone. So I have started scalping again. I have started day trading and we're doing very well, which is phenomenal. I'm super excited about that. But that doesn't mean that I'm removing 99% of my assets that are all into long positions, right? I'm just not going to do it. I'll take a 1%. Take a 1% to scalp, make some extra money, pay for my exorbitant amount of food that I eat. So just to go over a quick trade with you all, I had a 2 to 3 month time frame on this trade that I was expecting to hold it for to get as much profit as possible or as much of the credit as possible. And I explain what I mean by credit. So on Monday, we had quite the pullback in XLF. And I was looking at the rest of the banks and the banks were getting slaughtered, respectfully.
Yeah, they were
getting slammed. And I was thinking to myself, okay, if the banks are overextended to the downside, RSI saying they're oversold, a selling volume was flying in like no other. Thinking to myself, okay, this might be a good time for the strategy that I deploy. And the strategy that I deploy is I incrementally leg into long. Either there's 3 things involved here. The first thing, and about 80% of my trades are bull put credit spreads, 3 to 4 months out, depending upon how far the drop is. So the further the drop, the shorter I go in expiration because I'm expecting a quicker recovery because we're so close to either an 180-day support or a month support, depending upon how far we fall. Hopefully it's never an 180-day support. That'd be very bad. But that being said, Guys, the spread that I chose, and I was very public with my group in my live chat about this, the spread that I chose was 2, as a matter of fact. It was December 17th expiration. I bought the first leg that I bought was a wider spread because I just wanted to be a little bit more safe. I bought the 38 put and I sold the $40 put. And that created a $2 spread with a decent credit because it was at such a decent pullback. I think I got into those at 37. And then my second leg, because I didn't think it was going to break down a whole lot past 37. And I usually go in with my ETFs. It's either 5 legs of large increments or 10 legs of small increments. SPY, for example, has multiple percentage drops and a trade in a range where it could fall. So I do 10 increments usually with SPY, and I never get to the last 3 or 4. I always keep that in cash. XLF, however, does not have that large of a pullback in regards to dollar value for me. So I kind of just average in the percentages, go through the percentages in my head as quickly as I can. And I leg in accordingly based on the drops that I'm seeing and retracement from the all-time highs to the lows that we're creating now. And then I also use previous ranges from highs to lows to determine how far I think XLF could fall in the present time. So that being said, my first entry was around the 37 point. I'm sorry, it was about the 37 midpoint, was right in here before we actually really fell on Monday. And my last leg was intraday here. So I got a mid to low $36 per share entry. Now, I was expecting to hold this up until the $39 price. And I was expecting it to take at least a month to get back up to that point. That being said, the credit spreads that I got into, and I usually look for about 20 to 30% return on my credit spreads. These were bull put credit spreads, again, out to December. And the first leg I bought was a 38 buy of the 38 put and a sell of the 40 put. I then turned around on the next leg and I got a tighter spread for more maximum profit. And I bought a 39 put and a 40 and sold the 40 put. So it was a $1 spread rather than a 2. So it was less expensive, but it was more profit it was a better profit to loss ratio. And that's a little riskier just in comparison. But that also being said, it was down another $1 from my entry, which on XLF here, as we're seeing, is quite a pullback. I mean, this was a large gap down. But that also being said, this past week on Friday, I was already up 12% on the position, and ETF trades, bull put credit spreads for ETFs are my largest allocated positions. So that was the most I have ever returned in the shortest period of time on an XLF trade. So I took it. I got out. And XLF ran up so quickly and so fast, the only thing my brain was telling me is we are going to pull back to go higher. If you want to take your profits and you don't want to sit around for the pullback, take them. And I could be completely wrong. We could go right back up to 39. I could hit my price target and I could be missing out on an extra 5 to 8%. Best part about it is I don't care. I just don't. So I am more focused on making sure that I am capping my gains, and not capping my gains, guaranteeing my gains and getting out of the position. That was the quickest run up I have seen out of XLF in the span of literally last week from Monday to Friday. We had run up 30, let's say 30. We've got a wick all the way down here at almost $36 flat, which is unbelievable. And I was out at 38.2, I believe. That was where I was getting out of my spreads. So if I do a little quick math here, let's do 36 flat divided by 38.2. XLF did 5.8% in a week. So that was one of the major reasons why the other side of my brain was telling me to get the hell out, because that's a great play. And I was expecting it to be long term. I was trading for it to be out to December, right? But a 5% return on shares, which I also hold, and a 12%. I'm sorry. Yeah, and a 12% return on the credit spreads when that's one of my largest trades, most allocated capital. I was absolutely fine. That's a great trade right there. So, and that's a
brilliant trade.
Yeah, and it's safe, right? That bull put credit spread is extremely safe. small explanation. For those credit spreads, in order for me to make the entirety of the credit is the difference between the put I sold and the put I bought. You have to be at or above, for both of those spreads, have to be at or above $40 a share for you to make max profit by expiration. And I pulled out 12% in a week and was very fine with that. Rohan, I know I've been talking about this trading shit for a while. What do you have to throw into it?
So, looking into the financial sector, you guys already know my opinion. Financials are key, but as you'll see, later on down the line in our live video, we'll be covering the difference between financials and fintech. And I know that Clayton has wanted to talk about Facebook as well. So why don't we just hop right into Facebook and then we can go right to the live.
Oh, that's not a problem with me at all. So, all right, let's cover this real quick. Guys, I am not a huge advocate of Mark Zuckerberg, right? But that doesn't mean I don't like making money on FANG, right? I'm going to be making money on FANG till I die. So that being said, Zuckerberg, in my general opinion, was trying to do his absolute best to pay off, and let me get the commission correct, with who that he was trying to pay off and who he was trying to keep his name away from.
So
let's look at this. So we pull up the news here real quick. So the major pullback that we saw was because of, and this was on the 20, here we go, Facebook. Okay, so we had a couple of different news catalysts. We got a headline here saying that Facebook stock falls after exec highlights impact from Apple's privacy changes. So usually every time we see Facebook or one of the major tech stocks get hit, it's because somebody was poking their nose where it doesn't belong. I hate to dumb this down, but that's literally what it was, right? Somebody's infringing upon privacy rights, privacy acts, and that's where these lawsuits come full circle and hit Zuckerberg in the forehead and bounce right off because he doesn't care. Doesn't care, right? Google doesn't care. Facebook doesn't. Apple doesn't care at all. Could care less. You cannot tell a $1 trillion company to worry about a $100 million lawsuit. Like, give me a break. Give me a break. It's just politics. These guys are coming in and going and looking at Zuckerberg and going, we told you not to do that. You have to pay us $100 million now. And Zuckerberg's just going, yeah, all right. Yeah.
Heck no.
So Zuckerberg signs the check and walks away. Like, this is if somebody slapped you on the wrist and gave like everyday people like Rohan and I a parking ticket, right? It's going to piss us off, but it's a freaking parking ticket. And that's literally what these guys are dealing with. And that's unfortunately, I hate to say it, but that is the proportion. That's the proportion that we're looking at. So give me some info on Facebook before I cover some of these other headlines.
Sure thing. So Facebook this week had news on Wednesday that its chief technology officer was stepping down. Now, whenever you have uncertainty about the leadership of a certain company, shareholders start to get scared, right? So they'll start to, just a little bit, start to sell off some shares because they start to get a little bit antsy. Like, okay, what's happening internally at Facebook? Are they stable? Are they doing X, Y, and Z? There's lots of resistance to their Ray-Ban partnership for the smart glasses. People are saying they do not want anything to do with it. They will be tracking data. They will be tracking where you're going, trying to see how they can better improve. We live in a data-driven society. I am not opposed to it, but a lot of people are. So as products meet resistance, as does the shareholder price, right? So as all of these things start to hit the market, as Facebook starts to, regain a little bit more stability in its leadership and its product differentiation strategies, we should start to see some stability in its price as well.
I couldn't agree with that more. And we're going to look at the chart here for a second, and we're going to cap this off here in a minute or so. So we're just going to cover this quickly. Facebook's been trading in one heck of a channel, and it broke out of that channel. And every single time, every single time a major tech stock on a high time frame breaks out of a channel, you have a lot of eyes on deck. And I'm talking about big money. I'm talking about smart money, right? Because you've got all these banks coming out and going, Facebook, $400 a share, no less. No less.
No less.
Got Facebook, $450 a share, no less. All right. Don't bother me until it gets there. Right. And these are buy ratings, overweight rating, etc. I mean, it's just all out buy ratings on Facebook. It's all I've been seeing. I haven't seen anyone bearish on Facebook, especially with the big banks. So, and I could be wrong in saying that. I'm sure there's a bear or two. I'm sure Michael Burry's sniffing around somewhere. But so for me, when it breaks out a trend, this past week, I gave Facebook a day to breathe, and I started getting in long positions. And I was already in long positions because it had already fallen. Let's take a look at here. And I'll just cap this off by saying, guys, you have to understand that if you start to give yourself some duration and expiration on your trades, you can have way more confidence in the positions you're leveraging into. And these options are still so much cheaper than buying Facebook at $355 a share. Lord have mercy. This is what we're trying to go over. So you get the leverage of 100 shares, but you ain't paying half of that, right? So I love this. I'm a huge buyer. This past week, I bought a lot at the 340, 344 level. And now we have extended past the 350 level that we had previously traded at before. It's overextension, in my opinion, into the 380 range. So any last words from you, Rohan, to cover everything that we've said today?
As it may seem, things look overextended, but in this underlying bull market, it's forming new trend lines every single day. That's all I'm going to leave off with.
I couldn't have said it better myself. Guys, if it's overextended, be patient. If you think it's a good buying opportunity, give yourself time, right? Give yourself some time for the position to develop. And if you guys were in long positions up in the 380 range or short positions up in the 380 range, reflect on how you could have made a better decision. Maybe added some expiration, maybe added a couple months out, maybe traded credit spreads or debit spreads, made your contracts cheaper so you're not losing so much.
You know, as my friend Clayton over here says, there's only successes and lessons.
I couldn't agree more. And that, in my opinion, that's an okay quote. All right, I'll brush my shoulder.
Okay. Yeah, it's okay.
I'll brush my shoulder off to that. Rohan, thank you so much for your time today. You are the absolute manimal. I love you, brother. And I appreciate your input as always. You are an incredible influence on me and a phenomenal portrayer of information. I love it.
I appreciate it, Clayton, your technical analysis skills and, you know, all the stuff that you do on a daily basis with OBR live, by the way, every day, is absolutely amazing. And I really wish, you know, if I wasn't working a goddamn 5 to 9, I said that on purpose. If I wasn't doing that, I'd be in there every day listening to what this guy has to say. You know, so don't forget, you know, if you guys are listening to this right now, and by the way, you stuck around for the entire video, you are absolutely amazing. If you're listening to this right now, go join Clayton every single day. He is live on OBR, and I kid you not, it is gold every single day that he gives.
I appreciate that very much. I try to do my best to help all of our members and everybody who hops in. I'm very much focused on you all, which is why Rohan and I sit down, and he is as well. That's why we sit down and we do these videos, and we try to provide as much information to you guys, as much applicable information to you guys as possible. So you guys take care, and we'll see you guys in OBR, and we'll see you all next weekend for some more TA.
See you guys in the live. Bye. Whew. All right.